Losing a spouse is one of the most emotionally difficult seasons of life, but what most people don't realize is that it's also one of the most financially punishing, because buried in the tax code are silent penalties for surviving spouses, higher tax brackets, higher Medicare premiums, and reduced flexibility within your financial plan. Today I want to walk you through why widows and widowers face a stealth tax hike when a spouse passes away, and what you can do right now while both spouses are still here to help reduce this later on. And before we dive in, my name is Ryan Knoll. I'm a certified financial planner and founder of NAV Wealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's jump into the video. When one spouse passes away, the surviving spouse goes from married filing jointly to filing as a solo taxpayer in future years. That may seem like a small shift, but that small shift has massive tax consequences. In 2025, the 12% tax bracket goes up $94,700, while that same tax bracket for single filers is $43,750. That's half the room for taxable income before bumping up into the higher rate. So if a surviving spouse continues drawing on the same portfolio, keeps getting the same pension and Social Security, they're now paying more in taxes simply because they're filing solo. But also be sure, if your spouse passes away and you have minor children at home, that you file as a surviving spouse for the next 2 years. That gives you an extra 2 years of preferential tax treatment, which may not seem like much, but it's also buying you 2 more years of time to come up with a solid game plan when you start facing the more punitive tax rates. But this just isn't about income tax. This ripples down to touch capital gains, Medicare costs, and your long-term tax strategy as well. Next, I want to talk a little bit about the capital gains trap. And this is a common scenario that I see. So imagine a couple owns a taxable investment account worth $500,000 in appreciated stocks and mutual funds. When one spouse passes away, the account may receive a step up in cost basis, which resets capital gains and can reduce future taxes. But here's the catch. The rules differ based on account titling and state laws. In community property states like Texas and California, the surviving spouse might get a full step up on the entire account. But in separate property states like Florida and New York, only half the account may get a step up in basis. That means if the surviving spouse sells investments later on, they may still owe capital gains taxes. And those gains could push them into over the $47,025 threshold, where capital gains jump from 0 to 15%, or over $518,900 where they jump over 20%. This is why capital gains planning, especially with highly appreciated assets, should be part of your strategy before a spouse passes. And much of the legwork needs to be done early on. You want to have a strategy which is tax efficient to help reduce capital gains regardless of if both spouses are living. Utilizing direct indexing and tax loss harvesting is a great approach, as is using municipal bonds and other fixed income to ensure gains are kept in check and are less punitive after the first spouse passes. The 2025 IRMAA brackets remain a major source of stealth penalties. If your modified adjusted gross income exceeds $103,000 as a single filer, you start paying extra for Medicare Part B and Part D, and it adds up fast. For example, a widow earning $120,000 might see their monthly Medicare premium jump by $69.90 or more, and the surcharge applies for the entire year. That's almost $850 extra each year. Now consider this, even if income remains steady after one spouse passes, the brackets are now half as wide, and IRMAA uses a 2-year look back. So if your spouse passes in 2025, 2023 is how far back the government will go to determine your surcharge, just when you're adjusting to a new financial life. The only way to avoid this is by planning before you would become a widow or widower. Roth Conversions, qualified charitable distributions, and reducing future required minimum distributions and keeping your modified adjusted gross income lower and IRMAA surcharges at bay. Next, we want to talk about proactive Roth conversion planning. This is one of the biggest missed opportunities I see in retirement plans. While both spouses are alive and filing jointly, you have more room to fill up lower tax brackets, especially the 12 or 22% brackets, by converting your traditional IRAs to Roth IRAs. And why does this matter? Because as your required minimum distributions grow in your 70s and 80s, they could force taxable income that lands your surviving spouse into much higher tax brackets. A Roth account, by contrast, has no required distributions and produces tax-free income later on. And here's a practical strategy that you can follow. Each year, look at how much room you have before hitting the next tax bracket. Factor in other income like Social Security or pensions. Convert just enough IRA dollars to avoid triggering IRMAA brackets. By doing this gradually between retirement age and 73, when RMDs begin, and if you are born after 1960, your RMDs begin at age 75, you can shrink your future tax burden and protect your spouse from an income spike that they did not see coming. And this is even more important for spouses with large age gaps. Spouses who do have age gaps can often see one spouse living decades longer than the other. That's 10 to 20 years, sometimes even more, of less advantageous tax brackets if not planned for appropriately. Now we want to talk a little bit about gifting and legacy planning. Once 2026 rolls around, the per-person exemption for estate purposes will be $15 million per recent legislation. That means married couples can shield about $30 million for estate tax purposes. If you have significant assets, including a home, IRAs, investment accounts, or businesses, it's time to consider some special things to do. One would be spousal lifetime access trusts to lock in current exemptions, annual gifting strategies to shift wealth out of your name and out of your estate and give it into the hands of the people you love the most. Roth Conversions is a legacy planning tool, and keeping beneficiary designations accurate and coordinated across accounts. Anything you have over that amount will be taxed at 35% for the first $1 million and over 40% for anything beyond the first $1 million. This is often the most overlooked side of tax planning, and I have seen it significantly reduce family wealth. And don't forget the emotional side of legacy. Creating a clear, tax-efficient plan means your spouse and your heirs won't be scrambling under stress, and they will have much more of what you work so hard for. The important takeaway is there's a limited window where planning is most powerful, and that's while both spouses are still alive. So here's what you can do. You want to maximize Roth conversions while filing jointly, harvest capital gains before tax brackets compress, reduce required minimum distributions that could inflate future income, address IRMAA proactively, not reactively, and clarify your legacy and gifting strategy now, not later. Widowhood planning may not be comfortable, but it's one of the kindest financial moves you can make for your spouse or your family. The tax code often punishes people who are least able to respond, but with intentional planning, you can reduce future tax burden, simplify your estate, and ensure your spouse is protected from financial whiplash. At NavWealth Partners, we help clients create smart tax retirement plans that go beyond just portfolio management, because retirement is about more than returns. It's about resilience. Thanks for watching, and as always, make smart money decisions.